Hey everyone, how's it going? So today I wanted to go over some of the risks of holding credit spreads to expiration. This is an actual real world example. I saw online where a member in a trading group actually had the 900-930 call credit spread in Tesla that expired this past Friday. And we can see that the stock actually closed right around the 910 level. I think it actually closed at 909. And they held this credit spread into expiration. They did not try to close it out. So basically, this is the trade, and I've kind of copied the post here and added a couple things just to kind of clarify some stuff. But basically, they're saying they have a problem on Friday, 10/23. They had an expiring position, the Tesla 900-930 bear call spread, and they had pin risk because the short was in the money. And now they are short 100 shares of Tesla. And they said the broker is pushing them to buy it back, but they're asking what to do. Has this happened to anyone? How can you solve this? And one thing that should be known is at expiration, any in-the-money options will be assigned, and out-of-the-money options will expire worthless. And a credit spread is a defined risk trade, but if you hold it into expiration, it's no longer a defined risk trade. So if we want to determine the risk here, we just multiply the strike width times 100 and then subtract our credit, and that tells us what our risk is. So in this particular trade, this 900-930 is a $30 wide credit spread. So that means 30 times 100 is 3,000. So this was roughly a $3,000 risk trade minus whatever premium they received. I do not know what the premium is that they received, but we know that the max risk was 3,000. And on Friday's close, Tesla closed actually at 909. So at the end of the day, right before close, they should have been able to buy this spread back for around $900 minus whatever their credit received. So their loss would have been 900 minus the credit received. And we can see that basically on Monday, Tesla opened at roughly $9.50 per share and then traded up all the way to 10.25 and closed at 10.25. So what happened on Saturday is their 900, because it was in the money, it was assigned, and they were now short 100 shares of Tesla at $900. And the 930 call, well, since it was out of the money, it expired worthless. So now they're short naked 100 shares of Tesla that is practically unhedged. And Monday, since the stock opened at $9.50, they're now down roughly $5,000 in this trade. And if they actually held this all the way to close Monday afternoon, they would actually be down roughly $12,400 because it closed at 10.24. So there's a couple of things you can do to maybe try to fix this. Number one is just don't hold credit spreads to expiration. Try to close them out before close. Some brokers, depending, will actually close your spreads, 30 minutes to an hour beforehand just to alleviate this type of risk. But not all will do this. Another thing that you can do is on Monday morning, you can buy back those shares to cover that short position. If the stock was actually to have dropped, then they probably could have closed this out break even, but that did not happen. Tesla actually shot up over the weekend, so it's put them down a major loss. Another thing that you can do, and I'll actually go back into the charts here and we'll show you how to do this, is you can sell an at the money or an in the money put, or you can actually sell a put and then buy a call both at the money, and this will actually make you synthetic long 100 shares. So now we can try and look at a few ways that maybe we could salvage this trade. Obviously buying back the shares is one way, but if we want to try and use options, one thing we can do is we can actually sell another put. That's an option. If we get assigned here, basically 100 shares will be put to us, but since we're short 100 shares, it would basically offset each other. So we would have 0 shares at the end of the day once we got assigned. But there is still a possibility that the stock could continue rising and then we would have to adjust this position daily. Another option is to sell the put and then buy the at-the-money call as well. And this is actually going to give us roughly, I guess, synthetic long 100 shares. It'll give us roughly the equivalent of 100 deltas. So if we are short 100 shares, by doing this will actually give us the equivalent to being long 100 shares. We can enter this trade for roughly a $50 debit. And this is going to fluctuate. It could be anywhere from a credit to a debit. It just depends on what the price is at the moment. But this is another option. But to do this, you're also going to have the funds to have this short naked put as well. So anyway, hopefully maybe this shed some light on one of the problems you can run into. Thanks for watching and have a great day. Bye.